First off, I talk about at the end of this report, but tomorrow is a holiday, so trading volume might be light. I don't really know what London and Asia session are going to look like, but I know New York session is probably going to be impacted because it's a American holiday. So just be mindful of that. Don't try to force anything. I know that Top Steps trading hours are going to be slightly affected. Um, so tomorrow might be one to just sit and be a market observer instead of trying to be a participant. Over the weekend, the total crypto market cap attempted to stabilize after experiencing one of its largest weekly pullbacks in recent months. Last week alone, the crypto market shed nearly $100 billion in total market cap as investors rapidly reduced exposure amid rising geopolitical uncertainty and growing concerns surrounding inflation and Federal Reserve policy expectations. During that decline, price traded directly into the broader bearish target zone that we had highlighted in previous reports. If you guys remember, at the end of April, beginning of May, when we were trading above the $2.6 trillion threshold, we had talked about a sustainable pullback, a healthy pullback would be down into the 2.45 trillion region. I know for a fact that we discussed that, and now here we are. And now buyers, like we had anticipated, have started to attempt to absorb some of the aggressive sell pressure that dominated markets throughout last week. As you guys can see in the screenshot, we dropped literally straight down into that base at 2.45 trillion. And since then, buyers have made an attempt to absorb some of the sell volume. Or we could see a scenario where this was just profit taking from sellers. Either or, right now, $2.45 trillion is our line in the sand. So far over the weekend, we have seen roughly about 70 to 80 billion dollars flow back into the crypto market as sentiment modestly has improved following reports suggesting progress may finally be developing between the United States and Iran. While markets remain extremely fragile, investors are beginning to cautiously, I repeat, cautiously price in the possibility that tensions in the Middle East may avoid escalating into a broader regional conflict, at least temporarily. The shift in sentiment came after President Donald Trump announced that a possible agreement between Washington and Tehran had been largely negotiated, sparking hopes that months of war and instability could potentially begin moving toward a diplomatic resolution. According to reports, the proposed memorandum of understanding would involve several major developments, including the reopening of the Strait of Hormuz, renewed regional peace discussions, and negotiations aimed at formally ending the U.S. Israel conflict involving Iran. This is critically important for global markets because disruption to the strait immediately impacts global energy markets, transportation costs, inflation expectations, and ultimately central bank policy decisions across the world. This is one of the major reasons markets have become so sensitive to every new headline coming out of the region. Trump stated over the weekend that an agreement would involve not only the United States and Iran, but also several regional powers, including Saudi Arabia, Qatar, Pakistan, Turkey, Egypt, Jordan, Bahrain, and the United Arab Emirates. He also noted that discussions with Israel Prime Minister Benjamin had gone very well, further fueling speculation that a broader regional framework could potentially be forming behind the scenes. Reports from Reuters suggest that proposed framework would unfold in multiple different stages. The first stage would formally end the active conflict, followed by efforts to resolve the Strait of Hormuz crisis and eventually open a 30-day negotiation window focused on establishing a more comprehensive long-term peace agreement. Axios reported that the deal being discussed may include allowing Iran to freely export oil again in exchange for the United States lifting certain sanctions and ending restrictions on Iranian ports. Additionally, reports also suggested that a framework could include commitments from Iran regarding nuclear weapons development and potentially discussions around its stockpile of enriched uranium. However, despite the optimism reflected in some of Trump's statements, Iranian officials quickly pushed back against the idea that a final agreement is close to completion. Iranian state-linked media acknowledged that negotiations are ongoing and that some progress has been made, but they emphasized that several major disagreements still remain unresolved. And as you can see, I highlighted that in bold. Why do you think that is? Because if headlines are saying one thing, but underneath the surface, we're not actually seeing any progress, then we as market participants need to be paying very close attention to that because we know it's going to have the inverse reaction on PA this upcoming week. One of the biggest sticking points continues to be the control of the Strait of Hormuz itself. Iran, I say Iran, Iran maintains that waterway falls within the territorial jurisdiction of Iran and Oman rather than international waterways, meaning Tehran believes it has sovereignty over the route. The United States, meanwhile, continues demanding unrestricted navigation rights and full reopening of the ship lane without Iranian interference or toll systems. This disagreement alone remains one of the most important variables markets need to monitor in the days ahead because it directly impacts oil supply, stability, and inflation expectations globally. So I highlighted that in bold. Another major issue remains Iran's nuclear program. The United States and Israel continue pressuring Iran to halt uranium enrichment activities entirely. While Iran has so far resisted making any immediate commitments on the issue, Iranian, Iranian officials describe the current proposal more as a framework agreement rather than a finalized deal, suggesting that many of the most difficult negotiations would still need to occur over the next 30 to 60 days if an initial agreement is reached. And that is a big if right now. This is why, despite the weekend recovery in crypto markets, remain extremely sensitive to headlines heading into the next week. And equities, obviously, of course, still haven't opened yet. So we need to see the price impacts that the weekend data has had before we fully gauge the market sentiment this week. Investors understand that negotiations are still fragile and that conflicting messaging continues emerging from both sides. At times, both the United States and Iran are signaling that progress is being made, while simultaneously warning that military options still remain on the table. This contradiction is exactly why volatility remains elevated across global risk assets. Moving forward, there are several key developments that markets will need to closely monitor on the geopolitical front. So, first, we will need to watch for any official confirmation this week regarding the opening timelines for the Strait of Hormuz. Any signs that shipping routes are normalizing would likely reduce pressure on oil prices and ease inflationary fears, which could help improve broader risk sentiment across crypto and equities. The inverse of that would, of course, weigh negatively on global risk sentiment. Higher oil prices or any escalating tensions that drive demand for oil and bring fears of rising inflationary pressures back to the market. Second, markets will need to pay very close attention to whether sanction relief discussions begin materializing in official announcements. If the United States signals its willingness to ease sanctions on Iranian oil exports, this could potentially increase global oil supply expectations and place downward pressure on energy prices, which would likely be constructive for inflation-sensitive markets like crypto and equities. And third, we need to be paying very close attention to whether Israel publicly supports or resists any proposed agreement, especially around uranium. Multiple analysts have already noted that Israel's position could become one of the deciding factors in whether negotiations succeed or collapse. If tensions emerge between Washington and Israel regarding the direction of negotiations, markets could quickly shift back towards risk-off positioning. So outside of that, the uranium, Strait of Hormuz, how it affects oil prices, these are the things this week that we're going to be paying very close attention to in terms of the headline sentiment. At the same time, outside of the geopolitical headlines, this week's biggest macroeconomic focus will remain on inflationary data and Federal Reserve commentary. Government data due this Thursday is expected to show that the Personal Consumption Expenditures Price Index, or the core PCE, which is the Fed's preferred inflationary gauge, actually accelerated sharply to 3.8% year over year in April. If confirmed, this would represent the largest two-month acceleration increase in inflation since late 2021 and would further complicate, oh, that scared the shit out of me, and would further complicate the Federal Reserve's policy outlook. Let me meet you guys. I forget to turn my volume down in case anybody unmutes, because when you guys unmute, it's like a blast of volume. Several Federal Reserve officials are also scheduled to speak throughout this week. We have John Williams, Philip Jefferson, Neil Kashkari, and the list goes on. Markets will carefully analyze their comments for any signs that policymakers are becoming increasingly concerned about inflation risks tied to energy prices and ongoing supply disruptions stemming from the Middle East tensions. Importantly, Fed Governor Christopher Waller recently stated that the next move in interest rates is now just as likely to be a hike as it is a cut. So let me pause right there before I even finish reading the rest of this to make sure you guys are paying attention. Right now, there is about an 85% chance of a Fed rate hike this year, which is pretty crazy to see. So ideally, for risk sentiment to improve, one of the indicators that we can use this week as market participants that would like to see a risk on environment is this probability. So how would we like to see by the end of the week to see risk on backdrop come to the table? What would we like to see in this rate hike probability? We'd like to see this 85% do what?
Start down.
Go down, right? We'd like to see it come back down closer to 50% probability or something closer to zero. The higher that it gets to 100%, the more risk off it's going to be because not only is it going to lead to this market pricing in 100% probability of a rate hike, but it might also start to price in another rate hike, right? Which would not be good. So great job, Lee. That was good. This marks a substantial shift from earlier this month when markets were still pricing in a possible rate cut later this year. However, now Fed funds futures markets are pricing in roughly an 85% probability of at least one additional rate hike before year end, according to Bloomberg models. Bond markets are already reflecting this shift in expectations. Since the Middle East conflict escalated, the U.S. 10-year Treasury yield has surged roughly 65 basis points, while long-term inflation expectations have also risen. Rising yields, higher inflation expectations, and elevated oil prices, along with strengthening dollar, all contribute towards tighter global liquidity conditions, conditions that historically create pressure on risk assets like crypto. The key thing that investors will need to understand heading into this week is that markets may have already partially priced in one additional Fed hike. This means that if inflation data this week and Fed commentary merely confirm what markets are already expecting, we may not necessarily see an extreme market reaction. Instead, the biggest market moving outcomes would likely come from data that either significantly worsens or softens the current outlook. For example, if inflation data surprises hotter than expected, while Fed officials begin openly discussing the possibility of more aggressive tightening beyond what the markets are currently anticipating, risk assets could face another major wave of selling pressure. On the other hand, if inflation data comes in softer than what the market has currently been fearing or pricing in, and economic indicators continue to support the soft landing narrative, markets may interpret that as evidence that the Fed does not need to become more aggressive after all, which could scale back the higher percentage chance of a Fed rate hike and allow for risk assets like crypto to breathe some relief. Beyond inflation, markets will also monitor consumer confidence, durable goods orders, new home sales, GDP revisions, and merchandise trade data throughout the week. Gasoline prices are near their highest level since 2022, and they're already beginning to pressure household budgets. And economists currently are warning that any sustained higher energy prices could weaken consumer spending momentum heading into the summertime. From a market structure perspective, our broader technical outlook still remains largely unchanged for now. Crypto still trades below the key $2.6 trillion dark pool region. If buyers want to regain meaningful momentum and shift sentiment back towards a sustained bullish outlook, we need to see prices reclaim this level and successfully turn it into support, which we'll go over in just a second. Fundamentally, this would likely require easing geopolitical tensions, softer inflationary pressures, weaker oil and dollar strength, and economic data that keeps the soft landing narrative alive while negotiations between the United States and Iran continue progressing constructively. For the Nasdaq, reclaiming and holding above the 29,848 dark pool level could potentially open the door for a continuation towards new all-time highs above 30,000 if broader risk sentiment continues to improve. However, downside risks remain very real and cannot be ignored. If inflation fears continue rising, oil prices remain elevated, the dollar strengthens further due to higher inflation, or geopolitical tensions worsen again, liquidity conditions could tighten significantly across global markets. Investors also need to remain mindful of foreign exchange risks that still linger in the market, particularly involving the Japanese yen and the yen carry trade. As additional dollar strength and rising U.S. yields could increase the likelihood of a future intervention from many Japanese authorities. In that more bearish scenario, crypto continuing to trade below the $2.6 trillion level could open the door for a move back down towards the $2.3 trillion dark pool or potentially lower, while the Nasdaq could face a deeper correction toward the 2,700 to 26 range after its historic rally over recent months. 27,000 to 26,000. For now, patience remains extremely important. Tomorrow's holiday shortened trading conditions may produce lower liquidity and a more erratic price action environment, so the best approach may simply be waiting until Tuesday before forcing any trades. The next several days will likely determine whether markets begin stabilizing around a soft landing and de-escalation narrative, or whether inflationary pressures and geopolitical risks push investors further into risk-off positioning once again. So that is the first week's report. Make sure that you guys read this and understand the scenarios for this week.